Federal Reserve raised interest rates today by 0.5%. The move was expected. It was done to combat inflation. It's the first time in 22 years the central bank has hiked rates this much. In March, it ramped up its benchmark borrowing rate for the first time since 2018, increasing it by a 0.25 percentage point. And it's no secret that mortgage rates are quickly rising. Just 1 year ago, home buyers could lock in rates at historic lows.
Well, that's no longer the case, but is now the best time to actually hurry up and lock in a rate? Chief investigative reporter Eric Ross in studio getting expert advice from some of those loan originators. What are they telling you, Eric?
Rob and Diane, good afternoon. Despite mortgage rates rising, the housing market in Colorado Springs still appears hot with no immediate sign of slowing down. Mortgage rates are still competitive, but experts say there's a few factors you should consider before having your credit pulled. Colorado Springs remains a hot housing market, even with interest rates climbing. In 2020, interest rates dropped below 3% for a 30-year mortgage. Now rates sit between 5 and 6% for most buyers with good credit.
While they seem high and it happened quickly, they're still where they were before the pandemic happened, and it's still a great time to buy.
Shannon Schinkel is a loan originator at NFM Lending. She says while interest rates have soared in the last 3 to 4 months, it's not a time to panic.
Most lenders have a lock and shop policy. So if you're not ready right now, you can still lock in a loan. It varies by lender. It's between 60 and 90 days.
Some lenders will even lock in a loan for a longer term, giving you more security in this market. But she adds it's more important for home buyers to do their research by shopping around for rates and not necessarily going with the cheapest rate.
I will say that sometimes rates seem cheaper and it seems better, but not always. I've seen closing costs in the tens of thousands higher in order to secure that rate. So just be careful.
Another thing to consider is homes are selling above asking price and above appraisal value. Without 20% down or securing a VA loan, you'll likely end up paying private mortgage insurance. But
mortgage insurance at one time was avoided like the plague because it was expensive, because it added so much to your monthly payment, but currently it's not. It's not as expensive as it once was. Under current tax law, it's tax deductible, so it's not the kiss of death that it used to be. And I would encourage people, even with mortgage insurance, to consider buying a house if you don't have 20% down.
She says the 20% down rule is a misconception. You don't have to put a penny down on a VA loan, and for first-time home buyers, you can secure a mortgage with as little as 3% down. She says currently, even with a 5% fixed 30-year interest rate, homes are appreciating by about 13% in the Pikes Peak region every year. But for those who are skeptical about the market crashing and want to lock in a cheaper rate in the short term, an adjustable rate mortgage or ARM may sound more appealing, but Schinkel says you need to consider this.
ARMs will become more popular as rates rise. In the past couple of years, they really haven't because 30-year fixed rates were so low. As they creep up, it will be a potential way to save some money per month because the interest rate is lower because it's fixed for a short amount of time.
Bottom line, if you only plan on living in a home for a couple of years, it may be worth considering an ARM. But keep in mind, those rates can change by up to 5% after the fixed rate period is over. And that can leave some people in a very bad situation if they plan to be in a home long term and cannot refinance. We talk a lot more about interest rates and down payments on our website. Just head to KOAA.com for more information on this story, as well as an easy tool to help you calculate a mortgage payment. Rob and Diane?
Eric, great.